Welcome to the Cash Flow Champs podcast, the show where we demystify real estate investing so you have the tools you need to gain financial freedom through passive investments in real estate. And now your host, Cash Flow Champs Managing Partner, Prashant Kumar.
Well, hello. This is Prashant Kumar and Paul Senior from Cash Flow Champs. You are listening to Cash Flow Champs Real Estate Podcast. Today we have with us none other than Brad Summerock, the esteemed guest. Brad, welcome to the show.
Hey, Prashant, it's good to be here. I'm excited about today.
Awesome, Brad. Brad is the number one national educator and mentor in apartment investing business. After his beginning in 2002, he has owned and invested, and I think it is a dated number, 8,500 units, and received NAA Independent Owner of the Year award in 2012. Brad has taught thousands the proven, time-tested essentials of how to profitably invest in apartments. Hundreds have increased their net worth by over $1 million, and thousands are consistently earning double-digit returns as a direct result of his training and mentoring programs. Since 2012, Brad has helped his students acquire for over $5 billion in assets. His personal portfolio is over $800 million asset under management, and he has personally raised over $100 million for these deals. Brad, thank you so much again for your time. We are honored to have you today with us.
Hey, thank you. And yeah, those numbers are a little outdated, but they're close enough. I just crossed over the 10,000 unit threshold as a syndicator. And just to be clear, like for everybody listening, right? Like when people say 1,000 units, 2,000 units, 10,000 units, most of us don't own 100% of these buildings, and we embrace, and I know you guys do too, a syndication model. So yeah, I'm excited.
Awesome, Brad. Well, we thank you for coming on today. We appreciate you. So we're talking about syndication, and yeah, I mean, I'm glad you explained that. Some people think that syndicators are just as wealthy folks with 10,000 units by themselves, but definitely we syndicate them and we get other partners involved in these deals. What inspired you, Brad, to get into this asset class?
Well, look, I'll just say I never thought I would be here. I grew up with not a lot of money. My parents didn't go to college. I was taught to study hard, get good grades, get a degree. I did all that. Corporate America was not for me. I was told I didn't work hard enough, didn't come in early enough, didn't stay late enough, took all my lunches, took all my vacation.
I know.
and basically I was told several times that I didn't have what it takes. And I job hopped like every 3 to 5 years. I was like, man, I got to find something else. I got to go somewhere else. It was either not the right fit. I wasn't happy. I wasn't doing well. I got fired once. I got laid off once. So I found myself in my early 30s, just kind of floundering like so many people. It's like, what's the meaning of life? Why am I here? What am I meant to do? Surely there's more than this. And so I started studying for my third degree, the law school. I started studying for the law school exam, the LSAT. And at the same time, Rich Dad, Poor Dad came out. So that book, and then the second one, the Cash Flow Quadrant, that book inspired me to take action. And what I tell people, it wasn't the book that changed my life. It was the action I took after reading the book, because Kiyosaki says that specialized education could earn you a fortune, whereas formal education, which is what I had with 2 degrees, and I was planning on getting a third, could just merely get you a job. And so after reading that book, I sought out real estate education because Kiyosaki talks about that. And so I sought out seminars and conferences and mentorship. And that's how I got started. It was 22 years ago.
Wow, that's beautiful. And here you are 22 years later with all the accolades Prashant just talked about. So, that's a beautiful thing. And, Think and Grow Rich also talk about that specialized knowledge you make mention of that Kiyosaki talk about. And it looked like you just need to choose something and specialize in it and kind of advance it from there. So, I mean, in terms of what you've done so far and the things that you've accomplished so far, I mean, what do you think inspired you to keep going after all these years?
Well, it's funny because I feel like I'm just getting started. I do. It's like I mean, number one, I take care of myself physically and do my best to take care of myself, emotionally and spiritually. But I have a lot of energy. And so energy matters, if you don't feel like getting out of bed or you don't have energy to get through the day, how could you, fulfill your life's purpose? And I feel like my purpose is just to make an impact on as many people as I can. So I look up to people like Tony Robbins, like Grant Cardone. They're both in their early to mid 60s, and they've done more in the last decade than they did in the previous 2 decades. And so, I'm in that mid 50-ish point in my life where a lot of people might say, hey, why are you pushing yourself? But I look at it and say, hey, it meets a lot of my human needs. Like Tony Robbins talks about that. I'm a big Tony Robbins fan. And he talks about the need for certainty, the need for connection, the need for variety, the need for love, the need for growth, the need for contribution. Those are the top 6. And it meets a lot of those needs, pretty much all of them, because whether it's doing a deal, and I say doing deals puts money in the bank account. But when I got into the education business, it puts deposits into my spiritual account. So I like doing both. And obviously we make money from the education business too, but it's never been about the money.
It sounds like, it's very spiritual perspective that you have put together, Brad. I mean, it sounds like the decade of 50, from 50 to 60 is the time when folks are taking really next level growth. And I feel like maybe you are in that growth pattern at this time.
Well, I feel like I'm in the prime of my life, where others might be slowing down, I have my foot on the gas and it excites me. Like I'm excited to wake up every day. I'm excited to buy a deal. I'm excited to exit a deal. I'm excited to host an event. I'm excited to run my mastermind. I'm excited about, look, don't get me wrong. There's stuff that I got to do that I don't like to do. And that's also part of being a wise and mature and successful business person, because sometimes you just got to do stuff you don't want to do when you don't want to do it. But as we grow and we get to scale and build teams, I get to more and more do the things that I love to do the most and that I'm best at, and hire or outsource people to do the other stuff.
It sounds like, you have amazing quality to uplift yourselves. Pardon my language, shit always hits the fan, in this business, right? And it's so amazing to see you that you've come out of that. How do you come out of that? I want to learn that piece of it, I'm pretty sure, shit hits the fan all the time, and
there's shit hitting the fan right now. Like I've had 2 deals where we had to do capital calls. Like nobody wants to do a capital call. You might be surprised, Brad's saying that on a podcast. And it's like, look, but, for the past decade, we have had unprecedented tailwinds where one could be average and still do well. And what happened last year, we've had an unprecedented rise in interest rates. Just about everybody, probably you guys too, if you bought anything in the last 2 years, you probably have a variable rate loan. A lot of our insurance doubled or tripled depending on where you own, which is uncontrollable. Taxes have skyrocketed, prices have gone up, labor has gone up, and a lot of these have gone up way more than anybody could have possibly budgeted. So it's putting a challenge to a lot of syndication groups. And I think those that are strong with experience, track record, confidence, liquidity, that could communicate well to their investors, the good, the bad, and the ugly. Like we funded most of our capital call with our investors because we were able to show them the plan and we communicated to them. But others aren't so lucky. Others are making terrible decisions. They're not communicating. And, you know, I'm sure you've seen the news, like there's a large deal that, you know, went into foreclosure. And I'm going to tell you, there's more to come. There's going to be many, many more to come. I was just talking to a friend of mine this morning, not to mention his name, but he's a partial owner of a management company and they're being asked to take over people's deals. And some of these, and he just bought a note on a deal and he's going to foreclose on this deal. And so there is going to be, as Grant Cardone says, blood in the streets. The good news is if you can get through this period as a syndicator, you know, Tony Robbins talks about winter, economic winter is always followed by spring. This is not going to last forever. So my message to people that are in deals that are challenged is you got to get through it. This too shall pass. You absolutely have to get through it. What's happening now is temporary. And I've been through this before in 08, 9, and 10, not the exact same circumstances, but I've been through this last downturn. And I'm just going to tell you, nobody I know wishes they would have bought less real estate in 2008, 9, and 10. And nobody's going to look back 5 years from now and say, man, I wish I would have bought less real estate in 23 and 24. The deals are on sale now. You guys know this. There's been a pricing reset in the market. We could buy deals now for 15 to 30% cheaper than last year. You know, the negative is the cost of debt's still higher, but it's stabilizing. Like as of today's date, like it's easier to get debt today in the middle of April than it was in the middle of March. Okay, so things are calming down a little bit, but we're not out of the woods yet. But I'm seeing great buying opportunities. I'm selling a deal. I just got retraded by $800,000. And I accepted it. Well, they countered 1.2 and we were able to meet somewhere in the middle. But it's like, look, I don't like being retraded, but I didn't have a lot of other viable options. And so there's more power now for buyer groups. Like a year ago, if you retraded the deal, you were dead to the broker, to the seller, to the industry. And now, you know, we're seeing more buyer-friendly terms. We're seeing better pricing. We're seeing deals that are in progress could be renegotiated because the market has changed. The pricing has shifted. Cap rates have gone up 50 to 100 bips. So I'm excited about the opportunity, but also like, you know, I think the more you're comfortable being uncomfortable, you said you'd like to learn that. Like I could call it grit. I could call it resilience. But this is why, like some of my mentors, like Tony Robbins and Jesse Itzler, they have you do uncomfortable stuff, like cold plunging. I hate cold plunging, but I do it because it puts me in an uncomfortable situation. And the first time I did it, I thought I was going to die and I didn't die. And then I did it again. And now I've done it again. And now I do it again. And now it's like, it still sucks, but I know I'm not going to die. And I know how to breathe and talk my way through it. If that makes sense.
It does make sense. It does make sense. And you're speaking a lot to certain resilience and mindset that you have to get through tough times. And that's just beautiful to hear. I mean, you know, you talk about Tony Robbins, and I read it pretty much everything from his mentor, who is Jim Rohn. And, you know, I know a lot of things transfer down to Tony, and that's a good stance there. And for our audience, for those who don't know what a capital call is, that's when you have to go back to your investors to raise some capital that really you weren't expecting to do in order to make the deal viable or keep the deal going. So you speak to that, Brad, and I just want to see, I know you talk about communication, reaching out to your investors, but how is it that your investors are receiving that? I mean, and how is it that, you know, you can, in cases where those capital cannot be raised directly from the investors, if they don't have that liquidity available, what are the options there to make that deal go?
Yeah, so like I'll just give you an example. One of our deals, we have a rate cap, and for people that don't know what that is, you know, we got a deal in 2021 with a variable rate loan. And we were able to buy, when we purchased the deal, it's basically insurance that the rate won't go up more than like so many percent. Well, the rate has gone up way more than our cap, but our cap was only 2 years. And so now our cap comes due and we have to buy another cap. Well, just like any other type of insurance, when there's a lot of claims, the insurance goes up. And so when we bought the deal, our cap was, I don't know, 100K, and now it was like 2.5 million. So, you know, it's virtually impossible to budget for that. Like, we always raise extra money, but I don't know anybody that raises an extra 2.5 million to buy a cap that you may not even need. And it's never been needed before in history at that extreme. So like, you don't even have a rear view mirror reference point to say, oh my God, this happened back in X or Y. And so we got to be prepared for that. So, you know, that's the reason we didn't need the capital call because of poor operations, because of poor decisions. So we were able to communicate to our investors like, look, NOI is up 46%. Like but like selling the deal or refinancing deal is not viable right now because, you know, the debt proceeds won't be available. And so the plan is we got to get the extra funds to buy this rate cap so we could continue our business model and hold the property through this. The worst thing you can do during the downturn is sell. It's like, if you bought it here, and I don't know if this is audio or just a visual, but if you bought at 100 and you sell today, you might only get 90. But you know that this too shall pass, and it's going to be, you'll be able to meet and achieve your business plan. And I know because I've done it before. I bought deals in 07 and early 08 before that crash, and I held them until 14 or 15. And not only did investors get all their capital back, but they also made a profit. But if we would have had to sell, you know, in that downturn, there would have been losses of investment. And so, you know, again, the GP team, they need to have the wisdom, the maturity, the insight, the confidence, the business plan to communicate why we're doing a capital call, how important it is to do a capital call, the consequences of not, and I don't mean individual consequences like, you know, obviously, if you're not required to do the capital call, and then your ownership would be diluted based on everybody else's capital contribution. But, you know, if investors know and feel confident that you have a plan and that we're all in this together. I mean, look, 3 years ago when we were 3Xing everybody's money and we were projecting to 2X, we didn't get to keep a piece of the upside. Everybody was like, so giddy and so happy and bonus depreciation and nobody's paying tax and everybody's just loving it. And they don't say, Brad, you did such a good job. We think you should take a higher fee. We think you should get more of the upside. Thank you. No, but then when things go wrong, people forget about all the risks, about all the things in the PPM, about it was their decision to invest, you know, and all of a sudden they just, you know, some people start blaming and pointing fingers. And again, there's a difference between poor business decisions and poor execution, which obviously I believe happened in that Houston scenario, by the way. I'm not in the deal. I don't know the nuances of the deal, but from some of the things that I've heard, there were a lot of bad decisions made. But also we all have to understand that some of these things we're all going to be impacted with: rate increases, rate caps, increases in insurance, in taxes and supplies and labor. We're all going to be hit with that.
Brad, we know that nobody has the crystal ball, but you being a mentor, you being up there listening to a lot of good things from a lot of people, you know, you have access to a lot of information. Where do you think the market is going, you know, over the next 6 to 12 months and maybe in 24 months?
Well, let me talk about the debt first. And first of all, you're absolutely right. Nobody has a crystal ball. But I feel like, you know, the Fed was pretty clear on March 22nd they were supposed to raise rates 50 bips, and then 2 or 3 or 4 banks crashed, and they realized what they were doing had unintended consequences that they didn't forecast either. Okay. So, again, people could, it's like, but, I'm not saying I'm not saying they're smart, because I don't like the Fed and government and all that stuff, but they're educated people. Like, they're not dumb people either. Like, and well, I don't know. I shouldn't talk about that. That's just speculation. Everyone's going to have their own opinion on that one. But the point is, they didn't know what the consequences were. So these banks started failing, and then they raised interest rates 25 bips, but they also said, instead of that we're going to continue raising in the future, they said we're going to evaluate, whether we're going to continue raising or not. And that was a powerful pivot in their comments. It was more like a wait and see. So I think there's going to be maybe one more increase, maybe 2, but if it's 2, it's going to be like mild increases. And then I think we're going to see things flatten out. And I wouldn't be surprised by the end of 2023 if they're lowering rates. And here's the thing, once they start lowering rates, the floodgates will be open. People that wait are going to regret it. I heard this back in 2009 and 10, Brad, you're catching a falling knife. Why would you buy now? It's going to get worse. And I'm like, yeah, but these are pretty freaking good deals. Like, you got to know the game, and you got to know a good deal when you see it. And you never know when things are going to turn around. You never know when something could happen. And so people that think they know, they don't. But what you do need to know is you need to know what a good deal is, and you need to know what a good market is. And you need to know how to vet and select, if you're a passive investor, how to vet a GP team. And if you want to be a GP or a co-GP, you need to know how to select your GP partners. And those are the 3 skill sets that I think you need to be successful: is evaluate the deal, evaluate the market, and evaluate the team. And out of the 3, the team is the most critical. And this is where I disagree with Grant Cardone 100%, because Grant is like, it's all about the deal. It's all about the deal. It's all about the deal. And maybe it is for him, because he's assuming he's going to run it with his team. And if he has confidence in his team, which he does, then it's all about the deal. But if he's teaching somebody else to do their own deals, which I do, you got to have the GP team trumps the deal and the location.
I agree 100%. That GT team is critical. I mean, you got to bet on the jockey in that situation there, Brad, without a doubt. I would agree with you. Now, I mean, Brad, right now, agency debt and things like that, you're probably getting what, 6, maybe 60, maybe 65%, if that, LTV on these type of funding these days. And so you got to raise more equity for these deals per se, but at the same time, in your situation, at least you're making capital calls and things like that. So I'm just curious in terms of, the equity portion of it. How are you sourcing that? Are you going back to your original database from whom you did deals before, or how are you coming up with the equity for that?
Well, come back to me in a month, because we just got a 230 unit in Jacksonville, and we're going to need to raise. And you're right. So we're getting about a 65% loan. Rates are mid 5%. It's a good loan, 5 years IO, and it's fixed rate for 5 years. And then after 5 years, there's no prepayment. So I like that better than a 10-year with a hefty prepayment. It's from a life insurance co that we got this quote from. And everybody's saying it's harder to raise equity now, because the average investor has been bombarded with negative media, fear, foreclosures, this and that. So you always need to be communicating with your database. And my database is pretty big. And, I have a 506C database, and I have a 506B database, because they're not just people that have invested with me in the past. It's also people that have attended my training events, and I've been doing this for 22 years. So I think we'll be able to get the money, but everybody right now is saying it's a little harder to raise. Okay. Especially yeah, if I go to the same investor group that I just asked for additional capital, they might say, hey, I don't have any additional capital. I just put it in your last deal. And I'll say, thank you for doing that. Get some more money.
So Brad,
Join my program and get some more money. Go out and do deals and get some more money. Like, look, and see, that's the other thing people will do. They will look in the rear view mirror to make future decisions. Like, oh, the last year was crazy. I'm going to sit it out until we wait. It's like, no, you got to be greedy when everybody else is fearful, and be fearful when everybody else is greedy, which is not my quote, but Warren Buffett's quote. So like the fact that we had unprecedented, like shit hit the fan after COVID, the government printed money, they paid people to stay home. They created this whole thing. You guys know that they created this whole thing. And now they're trying to create a recession to get it back, to undo what they did. And so, again, it was kind of unprecedented. And I don't even know what your question was. Where I just went off on a tangent.
No, you are
You got it, Brad. You got it exactly right. I mean, you're a knowledgeable guy, so whatever you speak to us right now is good information. We appreciate it. Go ahead, Prashant.
No, my next question was actually, I mean, onto the same points. Investor sentiments are poor right now, right? I mean, if you had 10 investors last week, today you will find maybe 2 who will come and invest with you, right? That leaves you in the hands of pref equity kind of groups. Do you deal with those kind of groups for your deals? Because you had a capital call and you go back, ask for money again to your database. You will have a similar issue, right? So what are your thoughts about pref equity groups? When you have deal like this, 230 unit deal in Jacksonville, it must be $35 million deal.
Well, I'd rather not use pref equity because it introduces an additional layer of risk. And because, the pref equity is going to want, depending on how much they contribute, they're obviously, if it's pref, they're going to want paid first. So that's one thing, which isn't terrible. But then depending on how much they put in, they may want some sense of control. Okay. And so there's different types of equity too. There's syndicated equity. Pref equity is going to want maybe some control, or maybe they're going to be paid first. That's the definition of pref. But then there's also a term that I've heard thrown around called anchor equity. And it's like an LP, but like there was one deal I did where there was one company that stroked a check for $50 million. And then we raised $6 million from investors, and we needed $56 million, and one company put in 50. Now, don't you think that company that put in 50, they don't get paid first, but they have more say, they have more control, they have a say so on how things are going to be run, and so it's a double-edged sword to do it. And I would just tell you this, I've never used it on my own, but I'm in deals as a GP where we've used it. And what I mean by this is I've partnered up in a few deals with some people that are more sophisticated than me. They have these backgrounds. They understand, one of my GP partners, we're co-GPs in a few large deals, and he's got a Wall Street background. He used to work for Deutsche Bank and Goldman's. He could talk the talk and walk the walk. I can't. They'll look at me and be like, you're that guy from Pittsburgh. We ain't giving you the money. And I'd be like, I ain't taking your money because I don't understand what you're telling me. I'm a smart guy, but like, I don't have that background. So the thing is, I don't want to tell people to know their limits because we don't have limits. Okay. And I believe that. So I don't want to contradict myself, but I would just say that using preferred equity or anchor equity with strings attached is an advanced strategy that advanced beginners need to stay away from. And again, what happened in Houston was this guy was an advanced beginner, and he got over his skis. This is all my opinion, by the way, but he was an advanced beginner, and he was, debt was easy to get. Preferred equity was easy to get. He had built up a track record, but in a very short amount of time, and he talked a good game. And so, but, now looking back, it's like he probably got over his skis, made a lot of bad decisions. And so it introduces another layer of risk. And I would just say that don't do it unless you really understand how it works and what the, not only the upside, but the potential downside.
So, Brad, I know we are talking a lot about the future. I want to see, what do you have in store for yourself? I know we were talking earlier, you have few events coming up, things like that. Do you want to share the information with the audience?
Yeah, well, the first thing I want to say, and I already said it, but like we need to be buyers right now. Like, and I'm not just saying it, like JP Morgan Chase, the largest financial institution in the United States, came out in March with a commercial real estate report, 5 bullet points. And the last one was, you need to be a multifamily buyer in 2023. And why is that? And I'll just rattle off a few reasons. Number one, there's a shortage of housing, especially B and C class housing. Nobody's building it. Okay, so the families making 50, 60, 70,000 a year, there's not enough housing units for them. And for them to buy a single family home, this is not 2008. They can't just go out and get a stated no income loan, for 0% down. They got to put 20% down, have a 660 credit score. The median price of a single family home nationally has skyrocketed to $450,000. There's a huge affordability gap between renting and owning. It's a lot cheaper on average, $1,100 a month cheaper to rent than to own a median priced apartment versus a median priced home. So the demographics is favoring those of us that own apartment buildings. There's tons of pent up demand where millennials, moved back in with their parents during the pandemic, and they're ready to go back out and get their own place. And they're not gonna buy a house right away. They're gonna rent an apartment. So there's a lot of supply, demand, and balance. Okay, the fundamentals are still strong not in all markets, but in like landlord and business friendly markets with high job growth and high population growth. The rent growth is still positive. The population growth is positive. Jobs are still being created. If there's a limited window on the bonus depreciation, next year it's going to go down to 60%. This year it's 80%. So if you pay tax and you want to pay less tax, this year is better than next year. So there's a lot of reasons to get all in. Real estate's for sale. I haven't seen pricing this low since like 2017, 2018. And I haven't seen buyer-friendly terms like this since 2017 or 2018. And it's not going to stay here for long. It's not. And I don't know if it's going to be 2024 or 2025, but I'm telling you, we have a window of opportunity that will close in, 6 months, 12 months, 18 months. I don't have a crystal ball, but I'm just saying that's why now is a great time. And so that's what I see for the industry. And then like in my world, we're doing an event in August. It's our 6th annual Apartment Investor National Conference. It's a multi-speaker event. In the past, we've had the likes of Jesse Itzler, Grant Cardone, Robert Kiyosaki, Ed Milet, and then a lot of industry insiders too. Those guys are all Damon John, all these celebrities. But we've also had a lot of, top level people, 2 or 3 levels ahead of me kind of people at that event as well. So that's an event that everybody needs to be at, especially this year with everything going on. It's August 25, 6, and 7 in Dallas, Texas. And I'd love to give you guys like a QR code or something that you could, pass it out to your people. But for everybody that's listening, it's AIMNATCON, AIMNATCON.com. And there should be a landing page for that.
Awesome, Brad. Well, thank you so much. We're just going to finalize this into the lightning round here. We normally use this to finish off. We appreciate all the great commentary you've made here today. I know a lot of nuggets you've dropped for our audience to listen to. What's one piece of advice that's impacted your life that you received from someone, and how you think it may benefit others?
Well, the first thing comes to my mind is mentorship. Well, 2 things: mentorship and proximity. Proximity is power. That's a Tony Robbins saying. I don't know if he created it. Maybe it's a Jim Rohn thing, but proximity is like you become like the people you spend time with. So if you want to move the needle in your life, you got to be in the right room at the right conference around the right people. So people that are listening, it's a team sport. When I got into this business, I went to a seminar, hired a mentor, went back to work on Monday, they made fun of me. They're like, oh, how much did you spend? We were out on the lake. You missed out. You have FOMO. 3 years later, I quit my job. 20 years later, my net worth is 100 times what it was. And you know what? They're still working at Chevron, Texaco. They're probably making $250,000 a year, which is great. But big difference happens over time. So that's proximity and mentorship. Mentorship is the single best way to collapse timeframes and turn decades into days. And that's a cliche, maybe more than days. But anything you do, you could do on your own. But why not plug into somebody else that's been down the yellow brick road before you?
Right.
And Kiyosaki, even in the cash flow quadrant, when he says ESBI, most people think S stands for self-employed, but you know what else it stands for is do it yourself. And people that want to do everything themselves are going to stay small. And that's one of the things I like about Grant Cardone. He says collaboration is the new currency. And so if you're willing to have proximity, mentorship, and collaborate, whether trying to figure it out yourself and do it all yourself and be by yourself, that's a big difference in how you approach this business. So those are my tips.
Absolutely. Absolutely. Well, I want to thank you so much for coming on today. We really appreciate it. All information that you shared. Thank you so much for this information that you put out there to the Cash Flow Champs Real Estate Podcast. We want to stay connected with you, of course. And, best of luck for the rest of the year in terms of your acquisitions and everything you're going to have going forward. I know, Prashant, go ahead.
Just last question, Brad, how can folks reach out to you? There may be somebody who doesn't know. Most of the people know about you, but how can they reach out to you?
Yeah, so our website is bradsumrock.com. There's no C in my last name. It's BRADSUMROK.com. I'm also on social media. I have a lot of fake accounts, I found out. Some of them on Instagram have more followers than my real account, which how do they do that, by the way? But yeah, so everything, whether it's LinkedIn, Facebook, Instagram, it's just BRADSUMROK, no punctuation, no underscore, no other words, no other symbols. And I have a company that does a lot of posting for me, but I still look at the direct messages and respond to a lot of them myself.
That is awesome, Brad. Once again, thank you so much for your time today. We are humbled and honored to have you here on Cash Flow Champs Real Estate Podcast. Until next time, sir, thank you so much. Good luck.
Thank you.
And see you in August in Dallas.
Yeah.
Thank you for tuning in to this week's episode of the Cash Flow Champs Podcast. Cash Flow Champs partners with busy working professionals and entrepreneurs that want to build and maintain generational wealth through real estate. Visit cashflowchamps.com to learn more about us